Hello guys, Joe and Shannon here. So what we wanted to do today is just cover off some key topics that we're seeing in the world of not only cryptocurrencies, but as we've also always maintained with you guys, the importance of looking external to the market to really see what news is happening and what things are really coming into play right now and what impacts will this have in the world of cryptocurrencies. So we're going to cover off a few major articles of things that we're seeing right now that give you a bit of help and guidance when it does come to your investing in the space and what we're going to see next. So the first thing that I'll share with you guys is Bitcoin. Now, it's it's nothing new in terms of the price movements. Hopefully all of you guys have been keeping up to this and set alerts in place. So right now we've seen a trend over the last month move from just over 9K all the way down to around 6.5K. So what I'll do now is actually zoom in a bit more and start looking at this from a slightly different angle. So what we've seen over recent times and in the past are different buys and selling levels. So for the guys that came to the Mastermind event, Matt Harry spoke about this, and I really want to reiterate the points of this because it will give you a clear indication as to what could happen next based on data. As we've always said, we like to make informed decisions based on data. So if you see here, hopefully you guys can see my mouse, it says support failed. So what this means is as the price moves up and down, there's different levels of support. And when it breaks through that support, as it has done here, you can see the support level, which I'll explain what that is in a second. It opens up a gap for further price movement downwards. So the first support level or big support levels were here, which is 8,300. What this means, these charts on the left, these are when people have done the most buying and selling in the past. So when the volumes are high at these levels, this is where most people trade. And as you can see here, there's less people trading at different levels. And the big sign here that says open air, that's a big gap. There's not a lot of buying and selling that's done here. Therefore, there's not a lot of resistance levels. And in turn, that means that it generally wouldn't bounce forwards or bounce back off of that price. It's got a gap just to fall straight through. So 8.3 was one price. And as you can see, the next one's around here, which is anywhere from 6.7 down to 6.3. So right now, the price that we're currently at was actually here in the top screen, which is 6.614. And if you scroll down, this is on CoinMarketCap, just so you're aware. Some of the lowest levels that we've seen, you can see a 7-day low and high, 6.588. So we're still within that range. But if we do happen to fall to the lowest levels of just below 6.3, this could be a serious position and obviously movement to lower levels down here, which could almost fall completely down to 3.9. So do be aware there is absolute possibility that this could rebound and go to higher highs. But what we're seeing in the downturn, the shape of the wedge, we're seeing that it could move through this open air, but if it does go below the 6.3 level, all the way down to the low fours, possibly even high threes. So do be aware of this and take this into consideration in recent times. At this point, there's times for sitting on the sideline and there's times for making a play. Right now, if I were any of you guys, I would be sitting on the sideline, having that bird's eye view and making an informed decision, setting your alerts and your reminders in Blockfolio to say, at this point, I want an indication. And you might set one at 6.3, for example, or you might set one at 7K, because if it rises above that, there may be a chance that it could push further. If it goes below 6.3, then it could drop all the way down, and you're ready then, maybe setting another reminder at 4.5 to see what happens and how quickly that falls. And if this plays out, because the reality is just because it's happened in the past and it's gone through that and the data shows you these are the major buys and selling levels, it doesn't always play out how it's supposed to. But data would show you, and in the past it certainly has. So that's a really big one for you guys to watch out for. And please, if you've got any comments or questions around this, do let me know. So the next thing that I want to share, kind of jumping out of the world of crypto and looking at what's happening around the world on a global level. So this stood out to me. It hit me in the face when I first read it, and I found it very interesting and did a bit of further reading, and highly recommend you guys do too. So the Japanese government pension, which is one of the largest or the largest pension fund in the world, it does have numbers down here. So 42 trillion yen, 391 billion is what they're managing in that equities portfolio. And people have been trying to short this fund. And what shorting means is basically they're betting on the price or the value of the fund going down. So you're betting against it. Whereas a long would be you think that it's going to go up in value. So this to me is a big concern that they have stopped allowing people to short the fund because they don't want the price to drive down further. And what's really interesting in this particular article, which we can certainly share with you, Elon Musk is in here talking about how short selling should be illegal because so many people short Tesla. And in that, it does naturally drive down the price. And obviously, he doesn't like to see that in itself. So definitely have a read through of this and we can share this article, but do further due diligence and research. Super relevant and very interesting. And the only other thing that I do want to share is about China private firms are defaulting on bonds at the minute, which is $2 billion worth. And all we're looking for, kind of like the Hong Kong market has gone into recession, we're looking for that Lehman Brothers domino effect right now. And we're seeing, as a quick snapshot, we're seeing 60,000 job cuts through HSBC, Deutsche Bank. We're seeing larger Chinese companies that are defaulting on the bonds. We're seeing pension funds trying to be shorted because they're predominantly diversified into stocks and shares and also property. So really interesting points. What I want to do now, I want to hand back to Shannon, and hopefully you guys can still see me. So Shannon, hopefully you can take charge from here and continue on, because I'm not too sure how I can go back to your screen. Can you take charge?
I think if you go down the bottom, Joe, where you've highlighted screen share, maybe click on the same button and it will unhighlight screen share, possibly.
There you go.
There we go. That worked.
Someone knows what he's doing. So Shannon's got some really cool articles actually that he's going to share. So I won't talk too much about them, but it's absolutely fascinating. And like Robert Kiyosaki's book that I shared recently called Fake, it's really relevant to what Shannon's about to share. So please take the charge, Shannon, and fire on forwards.
All right, will do. So thank you very much for sharing everything with us. And now I'll get my screen up. So where I want to start is, I'll just move this out of the way so I can get to my screen. There we go. So we're going to have a look at a couple of different articles today, looking at the bigger picture of where our economy and the world economy, and I guess the transition into cryptocurrency, what we're seeing in the landscape at the moment. And I'll start on our home shores. So the first thing that has crossed my plate today, which I found very fascinating, is the Australian Federal Reserve talking about cutting interest rates again. So we've already seen them go to the lowest levels that we've ever seen them at. And now they're saying that there's about a 50-50 chance that they're going to bring it down another 2.5%. So that would bring it down to 0.5%, which is getting dangerously close to zero interest rates. And what's really fascinating about this is the reason that they cite for it. So what it's saying basically in the Sydney Morning Herald article is that the reason that the RBA is cutting these rates is because no one is spending money, which is an obvious one, but it's to do with the scare or the worry that they have at the rate that wages are increasing. So wages are just not increasing consistently with the amount of inflation that's increasing at the moment. And that mixed with the inflated property market, as you can see here, which is something we talk about at the free workshop, is really putting a massive squeeze on the amount of money people actually have to go and spend. With the huge amount they're paying in their mortgage, and the fact that their wage isn't going up to kind of meet that, means that the spending in the economy is just non-existent at the moment. And it's causing a really big concern for the Federal Reserve, which is what's a major factor in driving us down towards zero interest rates. And just to remind everyone of the graph that myself and Joe show at our free workshop, here is the graph of the way that wages have failed to keep up with housing prices since the 1970s. So the yellow line here is the amount that housing prices have increased on average, and the red line is the amount that wages have increased. Now, this is just to 2015, but just to really reiterate the point that this article from the Federal Reserve, which was only just released, is highlighting. The squeeze being put on people today is unprecedented and unsustainable. So yes, and this is our home shore, you know, and this article was written literally on the 17th of December, so only a few days ago.
Yeah.
Yesterday, in fact.
And just quickly, while you're on this point, this really backs up what we were talking about for the guys that did come along to the Mastermind event. 18 months in a row, new car sales are down. And then on top of that, the real estate agents group, REA group, they have released, I think it was 14 or 15% down year on year of that profit because people aren't spending on houses, people aren't buying new cars. And then Harris Scarf has recently gone under, and in terms of the retail market, people aren't spending. And we're quite fortunate, but we mentioned about Cyprus recently. You have to spend 30%. Was it Cyprus or Greece? Do you remember
Greece.
that? In Greece, you have to spend 30% of your income every month. Otherwise, they'll tax you extremely heavily on whatever you don't spend. So we're quite privileged in the sense that we're protected here and we don't have corrupt governments that keep taking people's money. But the reality is, if we do go into the negative interest rates, you will have to pay to keep your money in the bank.
Yeah, scary stuff. So moving on and transitioning from that to take a wider view on the way things are trending at the moment, I think it's important that people look at the facts the way they are, or the reality the way that it is, and not the way, I guess, the facade is trying to portray it. So this is a really obvious sign of the direction of the economy, but there's always going to be last-ditch efforts to try and make things look healthy so people don't lose confidence. So that's what I want to transition to now, because it's important that you really start to understand and not get sucked into the ignorance of just listening to, I guess, people that aren't necessarily portraying things to you the honest way. So this is The Guardian, so an international news company, very famous. What this article is basically talking about is the US Federal Reserve cutting interest rates, and then coupled with that, the spending that they're seeing on the S&P 500 over there. So the beginning of the article is going through how interest rates by the US Central Bank, for the third time this year, they have cut their interest rates. So 3 times in a row, they've been cutting it lower and lower and lower. And the really important thing to add to this, is the second piece of the pie, is that the US S&P 500 index is actually at record peaks. So what we recently spoke about this, myself and Joe, at our latest immersion. So to fill everyone else in, what's happening with quantitative easing is printing a lot of money to try and keep the economy afloat. Cutting interest rates is trying to make money as cheap as possible so that people spend more. So quantitative easing, they're printing a huge amount of money, and then what they're doing is they're dumping it into the stock market to boost the stock market up. So anyone just looking at a surface level on the news, tuning in, they'll see, oh, the economy looks really healthy. The US S&P 500 is not just high, it has reached new record peaks. So whilst interest rates are at new record lows, the lowest they've ever been, the stock market somehow, and we know how, is at record highs. So you can see how that does not correlate with what the true nature of the economy really is. And anyone just kind of tuning into the surface level would see, oh, cool, the stock market's really inflated. Oh, unemployment levels seem to be not too bad. You know, all these surface level indicators that they're able to manipulate show a strong economy. But the reality is, when we're trained to look for it, like you guys are becoming, and you really look deeper, you can see the true nature of reality, and you can make your decisions accordingly. So yeah, really fascinating and scary stuff there about the last ditch efforts to try and not admit that things are really bad. It's kind of like being caught out in a bad act and still lying about it, even though everyone's like, we've caught you, we know, but they're still refusing to break the story. So transitioning from that article is a very fascinating article that Sam added into our mastermind group.
I was just going to say,
Joe, you go.
Yeah, just before we do jump in, there's also been announcements that Switzerland, I believe it is, I'm pretty sure it's Switzerland, have done a lot of quantitative easing, and they've been using that to buy US stocks as well. So going back to the book that I was speaking to you guys about, Fake by Robert Kiyosaki, he talks about derivatives and creating all this fake money. And this is how the rich keep getting rich, because they're just overinflating a market. It's a great analogy here is we're taking the last final breaths of blowing into a balloon, and the balloon can't hold anymore because it's so overinflated as it is that it's about to literally go bang. The market around the GFC was had $700 billion worth of derivatives. And from what I understand, we're well into the trillions now of derivatives, fake money that's being created and reinvested into these markets to pump them up. You can't just create something and invest it, and then it just does not work. And it was the Goldman Sachs CEO, he admitted himself, he was like, this is a failed experiment. Printing money does not work. You can't keep buying stocks with it. So just do your due diligence and really use these points to leverage it and go into further research around.
Yeah, very valid point. Thank you, Joe. So it's not just an isolated event. This is happening in all the major nations around the world, as is evident and we can see. So moving forward from there, looking at a very global scale, this is an article that Sam, our content director, has put into the mastermind group. So I won't go through and read the article for you. I'm just going to highlight the main premises. This is in the mastermind group. So simply scroll through, grab the article, and you can read it yourself. Basically, what it's summarizing, it's from Deutsche Bank, and it's summarizing that they foresee that by 2030, no fiat currency will exist anymore, and it will all be cryptocurrency. Now, this is not some left-wing, futurist making this article. This is the Deutsche Bank's own article about the future of money in the world. So this is absolutely massive. And what we're seeing is so many major traditional financial institutes moving over into this world. So we can see the transitions happening already. At our free workshop, we allude to the fact that the Bank of America has the most blockchain patents for credits of anyone in the world, and they are a bank. This article here, which Joe kindly shared with me, it was released this year, the 6th of December. And basically what it's saying is a couple of real veterans from Morgan Stanley, they've been there 11 years, they have left Morgan Stanley to go on to create their own derivatives platform. Now, this is just one example upon a myriad of examples that we could pull up that shows how people from the traditional sector are moving over and creating the new wave of digital innovation in cryptocurrency. And to name a few older examples, we have the CEO of Commonwealth Bank moving from Commonwealth Bank to Block One, who created EOS. We have JP Morgan going from slamming cryptocurrency and Bitcoin to creating their own stable currency and saying that all banks can use that and trying to integrate their modern platform. The list literally goes on. We could scroll the internet for hours looking at example after example after example. But to keep it big picture right now, the trend here is the old system is dying, the new system is being created, and here is all the evidence to support that, which is very, very fascinating. And it's happening right now. So it's a very good time for us all to start positioning ourselves for the direction we foresee the future going. Joe, do you have anything you'd like to add on that? Because on that note, that's what I want to share.
Yeah, the only thing that I was going to share, if you can put it back on the big screen now. The only thing that I was going to share is the exact example that you did, the CEO of Commonwealth Bank moving to Block One, which is run by EOS. So yeah, some really interesting examples. And how I would really like to finish this up with you guys is really just kind of reiterating the point: money is made in research and when the market's moving down. So if you hit stop sharing, Shannon, then it should bring up the screen again.
Sorry. How do I do that, Joe?
So just at the top, the small little bar that should show up. So the big thing here, guys, do the work in a market that is moving down. That's where the money is made. And be aware of this, and make sure that that's your focus. And this is where your time is best spent right now, and how you can really get the most out of it. So if you've got any questions on anything that we've shared here, you want the links to the articles, you can just Google them and have a look yourself. But if you want the links or anything, do let us know. We're here to help you and give you the guidance that we can. And obviously, we've got some calls coming up soon as well. So anything that you'd like to share to finish up here, Shannon?
That's a wrap from me, Joe.
I like it. Awesome. Well, thanks for tuning in, guys. Thanks, Shannon, for your wisdom here as well, and sharing the points that you did. And hopefully this gives you some guidance and support to things that we're looking at right now, guys. Awesome. Well, thanks for your time.
Thank you, Joe.
And have a good day. Take care.
Thanks, guys.
See you later.